has been raised with me and by a number of people, and particularly why is it so important to have a CFO either early in the business's life or immediately at the beginning of a business. And I suppose one of the ways of trying to explain the importance is to take some case studies from my experience of people I've worked with over the last 40 years or so. A number of businesses, and I suppose it was probably more common in the pre-computer age, was that businessmen flew by the seat of their pants. They understood the business, they understood what they were doing, they understood the relationships, they'd probably worked in the business for a number of years, and they had it in their heads, and they just went out and they did it, and they sort of understood that if they charged X and their cost was Y, that there would be some profit at the end of the day. And accountants used to go in at the end of the year or after the end of the year and go through the manual books and records and put it all together on a extended trial balance, and the end of a month's worth of work would come up with the magic number of what the profit was, and nobody knew what the profit was until the accountants had been in and had done their piece of work. And usually the business owner's assumptions and feeling of the business was accurate. There were times when the business owners thought they were doing better, and it turned out they weren't. There were usually reasons for this, in that somebody in the business was doing something that they weren't supposed to do. I came across a case a long time ago where a whole load of purchase invoices were suppressed because they were under query, and nobody actually told me that they were under query. They weren't in the accounting records, and we missed a large number of invoices. Also going on at the time was a number of the salespeople were giving discounts out that they weren't supposed to, and the directors didn't know. So the company was doing a lot worse than the two directors thought it was, largely because things were happening that meant that sales were being understated and costs were being understated. So there was a significant surprise when all of that came about. Another business that I dealt with a number of years ago was in retail, and the business again was run by two brothers. They understood the business, they flew by the seat of their pants. They had manual records which were written up after the events, and they decided to expand. They got a computer system, and they got a bookkeeper in, but again, because their focus was on running the business, they didn't value the information from the accounting system. There were missing information, invoices were late, invoices weren't posted, payments were made because the directors were wanting to keep the products coming into the shops. And when the accounts were prepared after the year end, there was a huge issue because the costs were understated. There were manual adjustments to the VAT return that weren't reflected in the records, and there was a whole host of adjustments. And because they were flying by the seat of their pants, they didn't know that the expansion from, I think it was 2 shops to 5, meant that they lost their assumptions that they had when they had only 2 shops, didn't track to when they ran 5, and therefore costs were higher, sales were lower, and they lost a lot of money. So this is a situation that many traditional business people have found themselves in. But in the current climate, it's not necessary to be in that situation. The modern accounting systems have increasingly provided and enabled companies to be up to date on their accounting records, to capture information quickly. So it's on the director's responsibility to understand clearly where they are. What does the CFO do? I suppose the important part of the CFO's role to start with is cash. Have we got enough cash to get through the next 12 months? And that takes the form of a cash flow forecast showing all the expected expenditure in the next 12 months, and also the income that the company expects to have from its activities. This provides a basis of looking ahead. I was involved with a company a few years ago when I took over. The salesperson came to me and said, "I'm told I can't travel." And a salesman who can't travel doesn't sell. And a business whose salesman sits at home and is not selling is a business that has a limited life. So one of my first priorities when I prepared the cash flow forecast was to ensure, to sit with him and say, okay, when do you need to travel to the US? When do you need to travel to Europe? How much do you need to spend to do that? And to put it into the cash flow forecast as a matter of priority. And I was able to do that, and the business was able to afford it because we understood the cash flow, whereas before I arrived they didn't have that understanding. The other aspects of the CFO, what does he really do? Okay, so CFO manages cash, prepares a budget from the cash flow forecast to understand what the business expects to sell or to spend during the next 12 months. And that forms a benchmark against which the actual performance can be measured. So if you assume that you're going to spend so much money on overheads, you can then test your assumption as you go through the year. If you have an assumption around sales and purchases and gross margin, you can test that against the actual performance of the business. So the actual performance acts as a check and a report back, and it may tell you that your assumption is wrong, that what you've been told is not correct, and therefore you can go into the business and understand what is actually true. The next stage from moving from the cash flow forecast to the budget is obviously management accounts, which is the basis in which you understand where the business is performing, and that connects back to the budget. And then I think finally looking ahead, where does the business need to be in the next 3 to 5 years? 5 years is a long time for a small medium-sized business. 3 years perhaps is better, but it enables you to look ahead. What are the changes that the CEO, the owners of the business want? Where do they want to be? What are their objectives? Do they want to grow the business? If so, how much? If they want to grow the business, what does that mean? What more do they have to sell? What new products do they want to bring on stream, or new services they want to develop? And to what extent does this imply investment in the development of new products and services? And if so, how much? And to what extent can the business afford that? Does the business have to get a new capital investment to be able to develop and create these new services? And if there's an assumption, which usually there's a gap between the development of the new service and the increase in overhead to take on the delivery of those services in due time, you may have 6 or 12 months worth of expenditure before you get the new income. Can you afford it? How do you afford it? What happens when the costs are higher and the sales are later? How does the business cope with that? And by looking ahead and by reporting back and talking with the management team and developing those understandings of where you want to go and what's happening in the business today, what's changing in the marketplace, what's changing with technology, you're able to help the business to navigate those objectives and to assist the management team in making changes to the business, making changes to the delivery, so that the business can either successfully achieve its objectives or perhaps change course if necessary and say, actually our assumptions were wrong, we can't do this, we need to pull back, and the business does survive, but perhaps in a different form. So the CFO provides a valuable service to the management team, and particularly the CFO, in providing checks and balances to the business and to its performance, and providing information so that the business is solvent and profitable and prospers.